Hi, my name is Grant.
And I'm Rajiv.
And today we're presenting Golar LNG, or GLNG. Currently, the stock price sits at $42.27, where we believe the stock is a buy, with 33.1% upside. We value the stock at $56.25 in 1 year. Golar largely operates through FLNG as the first pioneer in FLNG conversions. Golar operates in South America and Europe and boasts 2 development labs. Additionally, their headquarters is in Hamilton, Bermuda. Golar is the first company ever to provide FLNG as a service, with a majority of institutional ownership sitting at around 71%. Additionally, Golar owns 2 of the 10 FLNG units that are in operation across the entire globe. Golar currently has 3 vessels that have signed a contract. This includes Hilli and Gimi, which both are a conversion of an LNG carrier into an actual FLNG vessel. Additionally, Mark II, or MK2, otherwise known as Fuji, is under construction. It is a new build, which means that it will have higher capex but also higher potential returns.
Now let's look at the industry as a whole on why Golar is a buy. Typically, offshore LNG are built and pipelines are built to connect it to an onshore LNG plant where natural gases are stored. But FLNG, or floating LNG, liquefies the gas in the sea. This bypasses building the pipelines and lowers the cost and creates economies of smaller values. Additionally, it is expected to grow 10% annually through 2030 due to the increased amount of technology in this sector. Next, after the Russia-Ukraine war, the prices were higher, and this favors the long-term contracts that Golar has built. And additionally, China diversified their supply sources, and Europe cut their pipelines to Russia.
Now, why do we believe that Golar LNG is a buy? First and foremost, it is rapidly expanding its FLNG fleet. It currently has 2 converted FLNG units and is currently building a new build, which is Mark II, that will generate the same amount of revenue as the other 2 conversions combined. Additionally, Golar is planning a 4th and even a 5th vessel for future growth.
Next, their conversion specialization is their true moneymaker, since their conversion model lowers their capex versus traditional new build LNG plants. So their engineering efficiency creates cost advantage and contract competitiveness. This allows them to win contracts more consistently.
Additionally, Golar boasts more political protections than investors may think. This starts with President of Argentina, President Milei, who has many pro-LNG policies. Additionally, he has the power to veto most opposing party oppositions. Additionally, RIGI provides 30-year tax stability, and this increases heavily foreign investment.
Finally, their AI application and innovation, Golar actively integrates AI into engineering and project planning.
We believe that Golar LNG has a narrow economic moat. Firstly, it has several protections. This includes first mover advantage, a unique conversion strategy, and binding contracts through long-term leases that last around 20 years. However, there are some drawbacks. This includes the moderate bargaining power of customers and suppliers, which contributes to the narrow moat valuation. However, there is a low and insignificant threat of new entrants and substitutes, which means that FLNG is an undersaturated field.
Next are their main revenue drivers, which are their 3 assets. First, Hilli, which brings in 2.4 MTPA, and it's their first operational FLNG, and it just signed its redeployment starting in Q2 of 2027. Next is Gimi with 2.7 MTPA, and it's similar to Hilli, which is a Mark I, and this vessel recently started operations, so the backlog should be considered over revenue. And finally, Mark II Fuji with a 3.5 MTPA, and this is a new design. And while it's more expensive, it allows for higher efficiency, and altogether, this should increase its EBITDA.
Next, let's get into the financial analysis of Golar, starting with the income statement. From 2021 to 2024, the operations of Golar heavily depended upon Hilli. However, everything changed in 2025 with the construction of Gimi. Every time there is construction, this leads to an earnings dip, which is evident from the years 2023 to 2024. Next, for the balance sheet, assets have stabilized around $4 to $4.5 billion. For cash flow, Gimi has been able to flip cash flow from net negative to net positive in only 6 months, showing the profitability of the vessels. And lastly, it is natural for the share price to heavily fluctuate due to the capital-intensive operations of Golar. Golar does look expensive through its price to equity ratio along with its price to cash flow ratio due to the temporarily depressed cash flow. This is due to its heavy MK2 capex along with its Hilli transition. However, the strong margins indicate that Golar is heavily profitable once the vessels go into operation.
When LNG prices rise above the floor, Golar earns additional tariff revenue, and this must be accounted in the EBITDA for the final valuation.
We made several key assumptions, including a 10x base multiple for each FLNG unit, slightly adjusting based on profitability. And the industry average sits around 8 to 10x, and we chose the higher end of this due to the contract stability that Golar boasts. Additionally, for the commodity multiples, we chose a 5x multiple, which is lower due to more uncertainty when it comes to liquefied natural gas prices. However, our intrinsic value model, which came out to $73.33, is different from our 1-year valuation, as only some of the intrinsic value will be realized in only 1 year. So this valuation of $56.25, which has a 33% upside, is driven by EBITDA growth through the operations of Gimi, along with partial realization of commodity upside.
Now let's look at some investment risks. First, the geographical concentration. Since 80% of the EBITDA is tied to Argentina, political shifts could impact the LNG policy and capital flows. Next, LNG price collapse could delay new contracts and FIDs due to the commodity exposure risk. And the Mark III execution risk, a new build FLNG could increase the capex and increase the timeline as well. And finally, each FLNG is 30 to 40% of the EBITDA, so a single project disruption materially could impact the cash flow negatively. Now let's look at the ESG. The ESG score is 44, which is the industry average, and a CSA score of 42. Environmentally, the FLNG units reduce CO2 intensity versus traditional onshore liquefaction. And socially, they partner with local operatives like YPF to monetize stranded gas and support job creation. And finally, their governance, they have a majority independent board with regular oversight and self-assessments. Finally, let's look at the AI implications. First, their optimized operations and maintenance. They have AI-driven predictive maintenance, which improves uptime and asset longevity. And they also have some AI implications in the workforce productivity and innovation. And their energy demand growth with AI data centers, increased demand for reliable LNG-backed power, and the supply chain and project efficiency with digital modeling.
Why did we choose to do a sum of the parts or SOTP analysis over a DCF model? Well, the answer to that is that through an SOTP, we could evaluate each vessel, Hilli, Gimi, and Mark II individually and based on their own timeline, as opposed to a DCF where we would only assume a constant growth rate throughout.
This is GLNG versus S&P 500 over the past 3 months.
This graph shows how Golar has outperformed the top energy ETF by 75% in the past 2 years.
And thank you to our investors, Nick Pan and Sanjay Goyal, for helping us in our investment journey. And thank you, judges, for listening of why Golar LNG is a buy.